Here, before we dive into some of these pieces of paper that you won't be able to see, chat a couple things on some big changes that are coming to our industry.
Okay.
FHA and USDA just announced that anybody that is here that is considered a non-permanent resident, so you're here on a visa, doesn't matter what type of visa, if it's a special H-1 where you are an entrepreneur and you have a company that employs 500 people and you want to get an FHA loan, you're no longer entitled to that. This may roll in to see how this affects borrowers with tax ID numbers. Fannie Mae and Freddie Mac will adopt this as well in coming weeks and months. So that means that anybody that's here on a visa, they're here legally. They may, and we'll have to see how this rolls into people with employment authorization documentation, where they're legally here, they have the right to work here, they pay taxes here, they do all that stuff here, but do they have considered permanent residency, which is basically a green card, or you're in the process of obtaining that green card? We don't know if you're going to be able to get a loan anymore, and this is
Wow.
new, and this is an absolute political thing. It switches back and forth every time a different president comes in. So, and it's not an affiliation with which side. I mean, I want every borrower to be able to get a loan, and I want everybody to be able to buy real estate, because that's how we make money. Like, I always laugh. My party color is green. And they're like, environmental? Like, no, money, green.
Money.
Like, that's my party affiliation. So that's a big thing that's coming. So really tricky. So it's almost to the point where if someone says yes, at what point does an agent start that pre-approval process to see whether they want to waste their time getting them into the car and showing them, at the same time not turning a potential buyer off and away? Do you start asking about residency status? I mean, that's a real touchy question. I mean, I even feel uncomfortable now doing it when I'm taking an FHA application. I'm like, what's your residency status? Are you a U.S. citizen? Do you have a green card? Tax ID number? What is it? Because it determines eligibility now. The other big...
So a question with that. So like in the past, you'd have a Canadian owner or buyer, right?
Right. Canadians are a little different because they're always going to be a non-QM type loan.
Yeah.
So it's not Fannie, Freddie, not FHA. You're going into... So that market is going to probably be the market for everybody that does it.
Okay.
But those are not low down payment markets.
Got it.
Those are not... Usually those are, like the Canadians come in when they did want to borrow our money, they would put 30, 40, 50% down.
Yeah.
They were strong borrowers.
Okay.
So then that brings us up to the next thing. It's the first page here is condos. Condos are on the hit list right now with Fannie Freddie. Any condo that has any sort of country club aspect to it is in the crosshairs right now. Fannie Mae's definition of a condo complex basically is a building that may have a common pool, and that's it. It's not a country club. It's not a tennis court. It doesn't have a restaurant. We are constantly having this list updated. So here is the ineligible list. The newest one is Desert Palms. That was added like 2 weeks ago. It was added in the middle of my transaction. It was added after I approved the loan, and in between approving the loan and drafting loan documents. They got flagged and added. So we had to completely redo this. So that doesn't mean that these are not lendable. It just means that we have to take a different approach with these mortgages, and it's not going to be a lot of times 5 or 10% down. It's going to be 20, 25 or 30% down. It's going to have higher rates because these condos are considered non-warrantable. And I fear that any condo that has a golf course, that has a restaurant, that has something, is eventually going to make this list. Now, Monterey Country Club was just removed, which is great, and so was Palm Desert Greens. So there's ways that these HOAs now are kind of trying to figure out how do we stick, because it affects property values. I mean, if you're telling me that I can only get, if a conforming loan on a condo with 25% down is 6.75, and then a non-warrantable condo, that rate is 7.625. That means those values go down in there.
Yeah.
So this is a hot button issue. And then while we're on the subject of rates, rates are Monday was the worst day I've ever seen for rates. Tuesday was worse than Monday. And so far today, I just got an update. Today was worse than yesterday.
Oh,
So,
jeez.
yeah, it's been a bloodbath. Let's see what's happening here.
It was just moving in the right
Well,
direction.
actually, today is coming back a little bit. It was moving great. The 10-year treasury was at like 3.98. We were seeing rates getting into the mid to low sixes again. I was so excited. Now we're seeing rates high sixes, 6.99. I mean, like with 1 point. Rates are up 0.5% since Friday.
Shoot.
And what's happening, and I'm hoping this will reverse. So anytime we see a big free fall, like we're seeing in the stock market, they take their money out of stocks and they move it to bonds for safety so that you don't lose as much. Well, a mortgage is a bond. And once everybody goes into bonds, yields go up because they become more valuable because more people are in them. Then interest rates then go up. So whenever you see the stock market goes down, usually you'll see interest rates go up. And that's what we are obviously seeing on a mass scale. What inside of this packet is some of the things that I always want to talk about. So condos, again, big, right? FHA approved condos. If you've got someone who's looking for FHA, this is the new list. VA approved. Here's the updated list. VA is obviously a lot bigger than FHA. So if you have a buyer that says, "Hey, I'm FHA because I've got a low credit score, or I need the benefits of an FHA, which is higher debt to income ratios, or lesser mortgage insurance, or just an overall cheaper payment, but they want to buy a condo," the condo has to be FHA approved. That list is very small because they're required to renew every 2 years, which is insane.
It's a lot of work.
That's a lot of work. So a lot of companies, a lot of HOAs just stop doing it. And they stop. And like, in fact, I have to update this list because I know Desert Falls just fell off. So I'll email you an updated list. VA, on the other hand, once you make VA's approval,
You're in.
They don't require you to renew.
All right.
It doesn't matter if the wheels fell off, if the HOA is being sued, they don't care. Once you're in, you're in. They don't look twice at it. What's next? What I print next here? Okay, so rates, right? How do we get our buyer that says, "Hey, I know rates are going to come down. They are going to come down.
Yeah.
I mean, they're going to come down. We've been saying this for years. It's going to happen one of these days." How do we get our buyer to say, "Hey, I need my payment to be X, but with this current rate environment, rates are going to be, if they don't change by the end of next week, we're going to see rates in the low sevens across the board with no points, maybe even mid sevens." So how do I get that guy to do it? Well, there's two ways to do it. One, you can do a permanent buy down. You get a seller credit to permanently reduce the interest rate. But right now we're seeing, like I just quoted the guy with perfect credit, 20% down, no points, 7.25, and with 1 point, 6.875. And it cost him $7,000 for the 1 point, and it only saved him about $140 a month. So 1 point isn't giving you that power to buy that rate much lower because it's just not built in right now. So you can't justify spending $7,000 to save $140. You don't recoup that for 5 years, 60 months. I mean, it's a waste of money.
Yeah.
So the 2-1 buy down is the big program that's going to come back like gangbusters right now. And what this is you get a seller credit to cover it, and it's usually about 2 to 2.5% of the purchase price of the home. So let's say the start rate today is at 7%. That's the 30-year fixed rate. The first year, the buyer's payment is based on 2% below that, which would be 5%. And the second year, that payment is based on 6%, 1% below the start rate. That's the 2-1 buy down. The rate is fixed at 7%. There's no negative amortization. Whatever that credit is, that seller credit, that's that 2.5%, that account or that money gets debited to make up the difference in the payment. So we can get our buyers into a house that has a payment based on a 5% rate, hoping that in a year or two, before it kicks up to the 7, rates go down.
Okay.
So it's a nice selling feature. It's something that we can go in and negotiate. The the key piece that I have the conversation with our clients is, hey, there's no guarantee that this is going to happen. Like I've been saying, rates are going to fall since 2023, right? Well, it's 2025, and obviously they haven't fallen. So you need to be comfortable in the event that this doesn't happen. But a lot of people are saying, "Oh, I'm new to my job. I get bonuses, I get raises. We can budget for this." When I did a comparison when rates were lower last week, if we went in with a $700,000 purchase price, a $750,000 purchase price, and you asked the seller for 3 points for a permanent buy down, right? So six on a $600,000 mortgage, assuming they put 20% down, that $18,000 that the seller would give, we were able to lower the buyer's payment by $400 a month. Now, if you go in and say, instead of the seller at $750 giving them $18,000, if the seller was to say, "Hey, well, we'll just lower the price to $732," that's $18,000 difference. The buyer puts in 20%, comes in with a little less money out of pocket, but only saves $150 a month with the lower price. So taking a higher price and getting a seller credit is another way that we can greatly reduce payment. So you've got a 2-1 buy down, or you've got a really large seller credit to go and buy down instead of doing a price reduction or coming in soft. So a lot of times we're finding it's better to go in high and ask for a credit back to buy your rate down instead of trying to come in and negotiate that as a lesser price point.
Right.
Because the overall goal, now if they're a cash buyer, this isn't applicable at all. So guys that are getting a loan, way better to say, "Hey, I'll take the $750 purchase price. Give me 18 or 20,000 back so I can buy my rate down instead of coming in at 730. To the seller, it's all the same. He nets the same or she nets the same, but the buyer, big difference.
Okay.
So really creative how we use these monies right now to go in. And it's a lot of times it's hard to say, "Hey, you'll probably be successful on if you come in 3 or 4% under and you get that back as a credit, than trying to come in, and make a price reduction. Overall, it's to save you monthly."
So one question on that is, let's say you keep the higher price, you're going to give them the bigger credit so they can do the buy down.
Mm-hmm.
Does the appraisal still have to come in at the bigger number?
Yeah, so that's to come in at the appraised price. So that's where it gets tricky. Now, so far, we haven't seen appraisal issues.
Okay.
But the way our market is turning, we're seeing a lot of homes selling for under list. List is, this is what my house was worth in November of last year. Well, we're in a completely different market in 4 or 5 months than we were of November of last year. So eventually we'll start to see, appraisals coming in lower. How will this work? Only time will tell.
Yeah.
Only time will tell.
Yeah.
But yeah, they will have to appraise at that higher number.
Okay. Any questions on that?
So if we go too fast, I'll leave my cards here. You can always call me and say, "Hey, was right over my head. I wasn't paying attention. I was looking at my email," whatever I do all the time, every time I sit in Zoom presentations. The next one is, how do we script against no? Or how do we script against I can't? You've got a client that says, "Oh, I would love to buy this house, but I'm self-employed. Oh, I'd love to buy this house, but I'm retired. I have no income. Oh, I'd love to buy this house, but I need 20% down. So I'd love to buy this house, but I have to sell my home first, and my home's been listed for sale for 6 months and it won't sell." So this is where we come up with some creative solutions in different loan programs. And the whole point of what I want you to know as the point of contact with your client is, and you being the real estate agent, not necessarily the lender, is know kind of what's out there. I'm self-employed. Well, there's bank statement programs that allow you to get a mortgage by looking at your bank statements and looking at deposits that go into your bank account instead of looking at your taxes. Because if you're self-employed, you make $100,000 and you tell the IRS you had $97,000 in expenses. That means that I only see $3,000 worth of income. But a bank statement, I look at 12 months of deposits that show that you actually brought in $100,000, and we're able to give you, a majority of that for qualifying income. Great program. A lot of clients that have 5 or 6 or 7 corporations choose to do this instead of the labor intensive of sending me, 2 years of tax returns for each corporation, P&Ls, bank statements, balance sheets, blah, blah, the list goes on and on. I'm retired. I'm retired and I'm asset heavy and income light. Well, there's two ways we can create income out of your retirement accounts, or we can look at an asset-based loan. So that's all you need to look to know. Hey, there are loans out there that simply look at your assets. You don't have to have any income.
Yeah, and that's one of the deals that Brad and I did together,
so.
where I had a great client, had a lot of money like in the bank, but didn't have any income. And in a traditional loan, they need to show monthly income. And so Brad's team was able to get creative about creating a monthly distribution from his retirement account so they could check the box that said he had monthly income coming in. Then we took the snapshot, got the client qualified, closed the loan, and then he could turn off the payment that was coming from his retirement fund.
That's exactly right.
That's why Brad's sitting here, because his company and him, they're very creative on how to solve the problems. Half of the problem is you have a buyer and they're just like overwhelmed, like, I like the house, but like I don't know how to figure out to
How
get
to do
it.
this.
Right? That's why Brad's here.
And then, I've got my house listed for sale. I need the proceeds from that sale to be able to buy this house. Well, we've got bridge loans, not bridge loans so you can pay cash, but bridge loans so we can access some of the money out of there so you can put 20, 25, 10, whatever percent down on the new house. Then when that home sells, you can take those proceeds then and go pay down up to 30% of that existing mortgage balance. So again, a way to say, hey, talk to Brad. He has a bridge loan. Maybe we can do a line of credit against your home. There's ways that we can do to access the capital that you need. And then I don't have a down payment. Well, any home buyer that's buying a home with a primary residence, doesn't matter if it's your first or fifth, you can go in as low as 5% for conventional, 3.5% for FHA. There's also down payment assistance programs that are out there. Now, the down payment assistance programs are a last resort. I'm not a big fan of them. And I'm not a big fan of them because of 2 or 3 reasons. One is the interest rates are really high. They're inflated. They're a percent and a half above the going rate. And they're set by the programs. They're not set by the lender. It's not like so if we go to Cal HFA, which is the one that I use the most because it is always funded. They have a rate sheet on their website. It's for everybody. It's about 1.5 higher for an FHA loan through them than that. The fees are expensive. They're almost at 2% now. But the biggest reason is that the down payment assistance gives you a silent second, and that's how you're able to come up. That covers your down payment. You cannot refinance until you pay that second off. So if you need it now, most likely you're going to need it in 6 months or a year. And if rates drop, that means that you can't take advantage of a lower rate unless you pay that off. So I'm not a big fan of that. And then the Riverside County program, that comes out every year. This is a great program, but it's almost impossible to get the money out of the county. The county dries up. So there's 2 broad stroke programs. One has no income limit. One requires you to have 80% of the area median income, which is like $68,000. $5,000 a month. You're buying maybe a house that's got a $2,000 payment, $300,000. There's not too many houses for sale for $300,000. So that program always has money in it, but the program that has no income restrictions, it's already out of funding. It was out of funding last month. It dries up first 2 months of the year. But it's still advertised. It's still on their website. Oh, yeah. So the people think, I'll just go to this program, get up to 20%. And then you go to apply. I'm like, well, we're a preferred lender there. There's no more money for that program. So those down payment assistance programs are out there, but they're tough. So it's just a way to help counter.
Let me ask you this. If when you get into a program like that, like let's say the Cal Halfa one, can the seller still help with the buy down?
Yes,
absolutely.
They can buy down. They can also, so the more assistance you get in those programs, the higher the rate. Mm-hmm. So a lot of times what we try to do is put them into an FHA loan, get a 6%, which is a lot, seller credit. So maybe we go in at list or even higher. That way you can take their base program, which has the fees, but the better rate.
Okay.
We get the seller to pay all the closing costs and the fees, and then you get the down payment assistance just for the down payment. So again, ways to kind of finagle this. I mean, we're talking a big difference in rates. The last time I checked, the base where they just gave you down payment assistance for the down payment, I think the rate was 6.5. Going up to cover down payment and closing costs was 7.625. I mean, it's a huge difference. So if we can get the seller, and then at the time, FHA was at 6.25 or 6.125, so still higher, but within reason. If we can get that seller to cover the fees and the closing costs, then that's a good way to structure it. And
Okay. So like for a first time home buyer or someone like who's just trying to get in, that might be the way to get creative. And, one reason I'm bringing that up is because, we're not in a market anymore where, the qual, like even if you make, if you make $70,000, $80,000, which is not a bad salary, like you're going to have a hard time getting into a purchase right now because of the interest rate. And
Right.
so for us to help them get over that hump, we got to think about, okay, how do we get them a credit back so that we can get the rate brought down, pay some of those fees. And there are more and more sellers now who've been on the market, who are getting more motivated, who, when they have an agent that presents something creative, are going to be more willing to hear this conversation because properties are not flying off the shelf like
Right.
they used to be.
yeah, I would agree. Would you say we're in a buyer's market?
I think we've shifted. I think we have.
Yeah.
I think there's still some properties like prime locations, highly upgraded properties that are flying off the shelf still relatively quick.
I agree.
But I do think that I just don't know if sellers quite know that yet.
No, they haven't figured it out.
They haven't figured it
I think that's a big piece. So the rest of these kind of flyers talk about the bank statement, talk about the asset depletion. What else I throw in here? Community lending programs. Have you guys heard of this program? This is offered through Chase and this is offered through Citibank. We will underwrite these loans for them. What this does is, and there's a map on the next page. Let's jump to that real quick. And it's the best map that I could find. So there are pockets. Anything yellow is a pocketed area. The property is in this yellow area, then you are eligible for discounted interest rates, discounted mortgage insurance. If we combine it with a different type of program, maybe no mortgage insurance, only because the house is here, no income restrictions, just has to be a primary residence. So for no other reason, just because it's in this yellow area. So the last time we did the census, they came out, every city across the country came out where they found underserved community areas in the community that are underserved by local banks. Local banks are not First Bank or Pacific Western, even though they got bought out. It's Chase, Wells Fargo's. These are national banks. Our valley in Southern California specifically really has a lot of areas compared to other towns and areas like San Diego or LA. They are not underserved. We are. So if you've got a listing that's in this kind of area, and you just email me your listings because you can look at this map, and unless you're a genius, you can figure out what is what street. But if you've got listings, send them to me and let me run them through the system. You can advertise that within the bounds, of course, of the MLS rules to say, property may be eligible under property is eligible for community lending. Your buyer may be eligible, blah, blah, blah. It's a big discount. I mean, we're talking 0.5% in rate just because you're here for no other reason.
Really?
Yeah. So this is
They can still use the normal programs?
30-year fixed.
Really?
Yep. It's in they're discounted.
But not like FHA stuff.
No, it's not FHA. This is only conventional.
Yeah. Okay.
But
Okay.
FHA and conventional, there's some big differences in those. If you can go conventional, it's a better loan because you can remove the mortgage insurance without refinancing once you get there. So if you're coming in with 10% down and you got good credit, much better to go into this program because the mortgage insurance will be cheaper than FHA and it'll get removed. If you can get the same rate and the same mortgage insurance, so if with 5% down with this compared to FHA, because the house is in this yellow box. Okay. This is a good program. It's a great way to make your sellers feel like you're the expert too, when you're saying, hey, you know what? There's this new program out. We just checked it. Your property's eligible. You look like a rock star just by bringing this up. And that's everything. And then they tell their neighbor, oh, you got a list with Gabe and his team because they figured out we're in a community lending area. Stupid things like that make all the difference.
Yeah.
And then, conforming limits. Conforming limits went up. Great way to advertise. You have a $900,000 house, that's listed for sale. A buyer can legitimately come in with just a little more than 10% down and buy that and get a great conforming interest rate. $806,500 is the conforming limit out here now in Riverside County. And FHA, it's up to $672,750. I thought it was 500. So
Nice.
these are big bumps to really make finding a way to get into a house easier. The higher conforming limit also allows us to do an 80-10-10. So if you've got $1 million house, we can put together an 80% first, a 10% down payment, and a 10% second. So they can truly come in with buy $1 million home and not get, I've got loans where you can go in and buy a $1.5 million home with 10% down. Rate's going to be almost 8%. It's terrible. Who wants that, right?
Yeah.
But go in with, what used to be 6 3/4 for that 800,000, put 10% down, and I'll give you a second for 8% only on the 100,000. Much better. So there's lots of little ways that we can put some of this stuff together for you guys.
Dang, Brad. It's good. That's why I brought Brad in. That was a lot of knowledge right there.
That was a lot.
And we recorded it for the record.
There you go. Perfect. So I'll leave these flyers here. I'll leave my cards here. If there's something in here that said, oh, I may have someone that's, needs help or has questions about it, or you want to dive into this more, call me. I'm here. This is why I'm here.
Cool. So you're still local? You still
here?
Around here?
Yep. Yeah. Pretty much.
Okay.
Pretty much.
All right.
Yeah, I live in Desert Falls. So when this got popped, I was like, you mother truckers, what did you do?
Wow. Yeah.
Because I want to sell my place and buy a single family home now.
So that makes the rate. So it's non-warrantable. It just basically means you're going to have to get a different kind of a loan.
You're going to have to get, so Fannie Mae calls a condo warrantable if it's eligible. And if it's not eligible, it's non-warrantable. And we put some notes in here when we go touching that, like Villa Portofino and Mesquite Country Club. Now, Mesquite Country Club is in Palm Springs. That will come off because this is on because the HOA sued the reserve because they took away their golf course. And then some of the members of the HOA then sued the HOA for suing the reserve because they didn't want the golf course. And so lenders just threw their hands up in the air and says, we don't want anything to do with this. I don't have one bank that would do that in there. But we heard the lawsuits have all been settled.
Okay.
The golf course is not coming back. The reserve is there. And hopefully this comes off. Villa Portofino is not till 2027. Villa Portofino is flagged because they have mandatory dues for membership into a facility that is not owned by the HOA.
Oh.
They lease it. So it's a mandatory on leased property, no go. As soon as they buy which happens in 2027, the clubhouse and the restaurant or whatever it is, the mandatory dues are not the killer now. It still will be non-warrantable, but I'll have a bank for it. Right now, when we go for these condos, we have like 10 or 15 of these special banks portfolio lenders, and not one of them will touch those. And then Canyon Heights is tough. Canyon Heights right now has a huge lawsuit, and it's an ambulance chasing lawsuit. But anytime you have a lawsuit where there's a death in the property and they are saying that the death of whoever was there was a result of the property, no lender wants to really touch it. I have been closing in there at higher rates for people. And it's a total nonsense lawsuit. Like the guy tripped on a puddle and a crack in the concrete and like broke his leg and then threw a blood clot and died. And they said, okay, well, the death is caused by him falling. And that's killed this community.
Hey, let's Two things I wanted to mention, just so they know. Franklin itself, like the structure, you guys fund
Yeah.
yourself.
So the way that Franklin Loan Center, we're what's called a direct lender. So we are going to fund our money and close the house or the mortgage with our funds. So when your insurance company says, who is your bank? Or the escrow company says, who is the bank? It is Franklin Loan Center. Now, we're not a servicer for most of our loans. We're going to sell them either to Fannie Mae or Freddie Mac directly or to another bank. But everybody that works for the company on every loan and every piece is a Franklin Loan Center employee. So the underwriters are employed by Franklin, processors, doc drawers, funders, everybody. That's what gives us a lot of flexibility to do things that other banks won't do.
Yeah.
For example, that community program that we have. So I've got one deal. In fact, when I got to get back, Chase is the bank. Chase has to give what's called a clear to close. So we underwrite the file, we send them the packet, and then they come back to us and say, yeah, this looks great. They're hung up on a letter of explanation. That's it. They don't like the letter of explanation. So we're like, okay, this is insane. So we're going to draft loan documents and fund this loan before we get Chase's clearance, because everything else is signed off except for this ridiculous letter. Other banks would never do that.
Right.
But we want to make sure we close on time. We have insurance done. I mean, we don't want the sellers to give them a notice to perform and cancel. The sellers don't want to sell now. So we're stuck. So we'll do things like that other places won't do.
Yep. That's a big deal. Especially when you're trying to get a creative deal across the line where you're working with maybe a first time home buyer or an investor, which is why Brad's been the guy for me on that.
Another piece too is that if you come to me and say, hey, the only way we're going to get this done is if you get me a 10-day appraisal and 10-day loan contingency, we've got to beat the other people. We can then come in and say, hey, this file is the number one file. Now, last month, I just got the stats. Last month, Palm Desert branch did $20 million in a funded volume and 22 transactions. 22 transactions. Yes, 22 transactions. Almost $1 million per transaction, which was really high numbers. I had 9 of those transactions for 9.4 million. So I have a lot of say when it comes to which file goes in front of everybody else, because I'm doing half the business of the entire branch. So it's been really helpful because we've had these crazy competitive. Had this one deal on Apache. We closed it in 18 days, beginning to end. Appraisal was done, jumbo mortgage, second review. The seller was unreal. He was a real estate agent out of Beverly Hills, treated us like garbage. We're the Valley. We don't know. He's Beverly Hills. And was like, get this deal done in 18 days and you can have it. I'm like, yeah, we'll get it done. And we did. And that was a lot of work, but we can do that stuff. So that helps.
Cool. Last question. Insurance. I don't need all of it, but like, is it getting any better? Have you figured out a path through? Like, are we still in muddy water?
It is getting better. We have 3 insurance companies that I reliably use. And with those 3, somebody has got something.
Okay.
So Palm Valley Insurance, Goosehead, they're not in the Valley, and then Ascend. And these guys are brokers. So they've got 5 or 6 different companies, and they each have 5 or 6 different companies. So yes.
Okay.
But what's tough is right now, anything near a hillside, is considered a fire danger. So like South Palm Springs, Bogart, way down there, back in here, there's no, PGA West, that's the same insurance rating as Idlewild and Big Bear because it's near a hill, this little hill right here.
What?
Yes. And they say it's a hillside. I'm like, there's not even a tree on that hill.
No, there's no brush,
not even a bush.
Yeah,
but it's near a hillside. So a lot of times you have to get the FAIR plan. And then you have to get
all the way down here.
Yep.
Oh my goodness. Okay.
So now as these fires get farther behind us, this will become more like Mercury just opened back up and they don't classify these places as hillside.
Okay.
But before they did, and then they said no. So insurance is getting easier. We tell everybody the day you get under contract is the day you start shopping for insurance.
Okay. Yeah. Yeah. And we've been saying that for a little bit. Like we used to be able to wait till the last minute and bring it in, you know, a week out. Like we need to start right out of the gate.
Right out of the gate. Because some companies are even coming back and saying, hey, we'll give you the quote, but we need 2 weeks to underwrite. And so that means you got to start now, because we do not want to go and request evidence and then we say, oh, we'll get it to you in 2 weeks, and then we have to delay our close of escrow for 2 weeks.
Yeah. Okay. Sweet. Cool. Any questions?